In this video, I explain profit calculation. I applied the profit and loss account. The video is linked to the chapter 11 of the textbook. I'm Carsten Berkau, full accounting professor in Osnabrück. My BasicsClips will help you to understand international bookkeeping. For the case study PELZERHAGEN, we want now to prepare the income statement, which means we first have to set up a profit and loss account. We start off where the expenses have been recorded. On the left hand side we see the accounts. Rent is 3,400, labor 48,000 and depreciation is 10,000. On the right hand side we see the revenue account. Revenue at PELZERHAGEN is 130,000. Next we prepare the profit and loss account. The profit and loss account will have a debit side and a credit side, and on the debit side we will record all the expenses, and on the credit side we will record the revenue. We call it the profit and loss account in the accounting period 2007. We have to close off the accounts to the profit and loss account. For the expense accounts, we make a debit entry in the profit and loss account, and we use the three-letter code that gives us a chance to see instantly what this entry is about. For example, rent. $3,400, and the contra entry is with the reference profit 7 loss 3,400. That means that the rent account at this stage will be closed off. That means that we don't have to care about this account any further. We do the same with labor and depreciation. The next step is we have to close off the revenue account. The procedure is very similar to what we did to the expenses, but now the bookkeeping entry is inverted. So we make a debit entry with the reference profit 7 loss in the revenue account 130,000. And we credit the profit and loss account. Next we balance off the account. We won't call this the balance carried down, but we give it a name. It is actually the pre-tax profit. However, we write brought down on the credit side 68,600. Next we have to calculate taxes. We have to multiply 68,600 with 30%. 20,580. The remainder, or 68,600 multiplied with 70%, will give us 48,020. That will be transferred to retained earnings. The profit and loss account will be zero balanced. Do not forget to make the contra entries. One of them is for the income tax liabilities, and the other account is retained earnings. As you can see, I prepared already the accounts. So you see the expense accounts like rent, labor, depreciation, and we recorded the revenue. So the revenue recognition has been made by the bookkeeping entry number 4. Instead of a number to identify the bookkeeping entry, I now use the three-letter code. So it is DPR for depreciation to the extent of 10,000. And the contra entry is recorded with profit 7 loss 10,000 in the depreciation account. Next I take rent. I make a debit entry in profit and loss 3,400, and I credit the amount to the rent account. I do the same for labor. Now I close off the revenue account to profit and loss. I make a debit entry in the revenue account with reference profit 7 loss. And I credit 130,000 to the profit and loss account. Reference is revenue. The next step is to balance off the profit and loss account. As the profit is the difference between revenue and all expenses, the balancing figure can be called the earnings before taxes, or EBT. Next, I calculate the income taxes. I write income tax liability and I put in the formula 30% or 0.3 multiplied with the pre-tax profit of 68,600. I immediately make the contra entry in the income tax liabilities account. The reference is profit 7 loss. Next, I calculate the annual surplus, which is recorded in the retained earnings account. Again, I calculate 70%, which I multiply with the 68,600, which gives me 48,000. The next step, I just must balance off the accounts. Next, I copy my results to the income statement. Revenue is 130,000. I got labor, which is 48,000. We got depreciation, which is 10,000. And we got other expenses, which we don't have to describe, so we only can record them as other expenses. Here it is 3,400. There is no interest. The income tax expenses are 30% of the pre-tax profit. On the balance sheet, we have to disclose the retained earnings, as they have been recorded in the retained earnings account, 48,020. The income tax liabilities are taken from the account. As we can see, the total of assets is the total of equity and liabilities. Now that you have seen the video, take the textbook and study the case.